Hello, everyone. Welcome to week 11 of our 12-week boot camp. I'm excited to be with you. As you can see by the slide, my name is Bill Quinn. I am your local financial professional. And as you can see by the caption there, I truly believe that the education and the information that's made available to the wealthier class in our country should be made available to everyone. That's what Wally is all about. We want to get this information out to people so they can make better financial decisions for their future. Hence, we put together this 12-week financial wellness boot camp. Week 11 is here. Excited to share the things we have for you this evening. But let's take a look at where we're at here. So let's check the progress. Building your financial plan. Today, you will be completing the last piece of the puzzle, guys. The overall financial plan. After today's lesson, we only have one lesson left that will actually tie everything that you've learned previously, everything together. I'm proud of you guys that have made it this far. I hope you're getting a lot of valuable information out of this plan. If you've missed anything, go back and take that class over. I would encourage you to go through the boot camp again and reiterate it for you. It's only going to make you stronger, better, and more prepared for your financial future. You are in the right place, guys, and you are on track. So aging is not for wimps, guys. As babies, we learned a lot of new skills as we grew up. You know, we were taught how to feed ourselves. We were taught how to walk, talk. We went through the whole potty training and learning how to clean ourselves, bathe ourselves, dress ourselves, so on and so forth. But by the time we're adults, we start taking all those kind of things for granted. It just becomes routine. It's a habit at that point, and we don't really even have to think about it. Our bodies and our minds age, however, we begin to lose these skills. These are called activities for daily living. So the basic things that you do every day to take care of yourself are what we call ADLs. In this lesson, we talk more about how to overcome the effects of aging on our lifestyles, and then how that can affect your finances as well. Many services are available to help people live independently and as safely as possible as we age. And we want to take care and make sure that we have the financial means to do so as we're moving forward in the process. So we're going to talk a little bit about Medicare. This is near and dear to my heart because I'm in the process right now of researching all the different companies that offer Medicare plans. And it can be a little challenging. But it is there for a reason. You know, we've all paid into these programs through our employers. As you pay in, you're typically paying in 1.5%. Your employer's matching 1.5%. Medicare is there for anybody who's age 65 or older. I'm 1 month away from being 65, so as I said, I'm looking into a lot of these things to find the best companies. Other people can get Medicare as well, but that's typically for people that have disabilities or blindness, and they need that financial assistance. And that's where a program like this can really be beneficial. It helps pay for many hospital services, many outpatient services, and of course, prescription drugs if they're necessary. So assume for a minute that you're over age 65, all right? You have a medical condition that needs treatment. Here's how Medicare is going to work for you. You receive medical services. Medicare pays a portion of the overall bill, which is about 80%. You end up paying the remaining 20% out of pocket. That's one option. Or you can purchase supplemental insurance that will help pay that 20% overage just by paying a small premium on a monthly basis to have that covered. Seriously worth looking into. You don't want to be waiting late in life and maybe if you're living on a very limited income, one major illness with that 20% out-of-pocket cost can be devastating for a lot of people. So here's some key statistics for us to take a look at. 1 in 3 Americans up here at the top, will partially lose the ability to take care of themselves during their lifetime. This means, they lose one or more of the self-help skills that we were just talking about. 1 in 4 Americans will live only fair or poor, will have only fair or poor health. Those people are highly likely to need Medicare support in their lifetimes. So 25% of the population, 32% of the population is quite a bit. Uh, 1 in 5 Americans, 5 or more chronic medical conditions, which means they will need serious medical help over many years. 15% are under age 65. These are the people considered legally disabled. So about 15% of the population is already on Medicare due to disabilities of some kind. 12% who rely on Medicare that are over age 85, which means they have been relying on Medicare for some time and they're well into retirement and they're starting to need that Medicare support. Only 3% of the Medicare recipients out there right now are in long-term care facilities. The number is so small because Medicare is not designed for long-term medical needs. In a minute, we're going to talk about the tools that are available to help you with those Medicare, where Medicaid can't help you, which is long-term care type of needs. So the average healthy 65-year-old couple retiring this year can expect to pay $390,000 or $540,000 in future value, meaning in the future as inflation affects this particular number here, in lifetime costs for Medicare, supplemental insurance, out-of-pocket costs, and other medical expenses. That's a huge number, guys. Think about that. Think about what you've got saved now. Think about what you have in position for maybe dealing with those things in the upcoming years as you start to age. How much do you want to have to budget toward your healthcare costs in retirement? Think about it. So here's me. And when I was younger, this is kind of the 60s here. Actually, that's the 70s. The long hair was in back then, guys. This, I think, was the 80s. This is on into the 90s. And of course, you can see here I am right now. This was not taken that long ago, so that's a pretty good, visual of me, as you can see on the screen as well. We all get old. Aging happens. It's just part of the process. Healthy aging should include thinking about your financial, medical, and family issues and the different things you can face when you get older. While you're still healthy, though, and able to make some good decisions about your potential living arrangements like nursing home, assisted living facilities, hospice care, home health care, and other available care options, and it really, of course, depending upon your condition, it's never too early to start thinking about these things and learning how to handle and pay for this stuff in old age. I know this is not a great conversation for, Sunday night dinner with the family and those kind of things, but it's necessary, guys. My wife and I have done it in the last 5 years with our children. We reiterate it every year so that everybody's on the same page. Luckily, being in the industry, we have everything in place and we're confident going forward that not only will our wishes be carried out properly if something should happen to either one of us, but our children will be taken care of, and we've put the right things in place to make sure that they know our final wishes. And we have confidence that they'll take good care of us even after we're gone. So let's consider all the options and the different various situations that we can look at here. So what is long-term care? Here we are with the ADLs again. It's a range of services and supports you may need to meet your personal care needs. Most long-term care is not medical care, but rather assistance with the basic personal task of everyday life. Sometimes called ADLs, we call them activities of daily living. So once again, just like when we were talking about the babies learning, toileting and bathing and dressing, it's almost like life becomes full circle. And all those things you learned at such a young age, now you're having to relearn them, or at least get somebody to help you with them because they become more of a challenge than they have been in the past. Long-term care services usually require that a person be unable to perform 2 of these activities for daily living before services are given by and covered by insurance. So long-term care, if you are young, you probably don't have any idea what this long-term care stuff is. But if you are and you're on board with us this evening, listening to this presentation, think about your parents, think about your grandparents. They could appreciate this conversation, and they could, I'm sure would appreciate your help in putting these kind of services into place for them so that they don't have to worry about them in the future. And yourself, knowing that this stuff is taken care of can be a tremendous relief for the younger generation. If for some reason your parents aren't properly prepared, and you may end up being the caregiver or the caretaker for their years as they age. So Understand gender is an issue with this. Average life expectancy for men is around 76 years here in the United States. For women, 81 years. So women are living about 5 years longer than us guys. Because of that, women are likely to have a greater need for long-term care because they will live long past when the guys pass away. If your parents or grandparents live past 90, you will likely live past 92. That's the genetics part of it. On the other hand, if several family members had conditions like cancer, you may be more susceptible too. This is my situation. My father's side of the family, cancer issues, a number of other different heart issues and stuff like that. Most of them didn't make it past 70. And on my mom's side of the family, I don't know what the deal is, but they all live into their late 90s, and my grandmother passed away at 101. So I'm hoping I'm kind of on that side of the gene pool when it comes to longevity. Lifestyle, of course, affects this as well. If you're a heavy drinker, you smoke, you have bad food choices, you have a bad basic lifestyle with no exercise. This is going to cut years off your life, guys. Healthier lifestyles usually lead to a longer lifespan. But also, may contribute to a few other medical conditions that affect those with less healthy lifestyles. So income level too, surprisingly, is an important aspect of this. When you're not stressed by money, you typically will live an average of 10 healthier years longer than someone who has financial stress in their life. Somebody who's struggling paycheck to paycheck, living on a very, very meager income. One of the driving factors around us teaching these courses, guys, is to help you become financially, well. Create financial independence for yourself. So take the financial stress out of your life, and you're welcome. We're going to give you 10 more years to live in the process of doing that. So some statistics: 70% of people turning 65 this year will need some type of long-term care in their lifetime. A lot of you are still young, healthy, energetic, and do not even think about these kind of things. But 2 out of 3 people on this call will require some kind of long-term care. And that's a huge number, guys. That's a huge, huge number. Since women live 5 years longer than men, women will require at least 3.7 years of long-term care on average, while men typically only about 2.2. The average cost of a bedroom in an assisted living facility right now in our area is about $43,000. An assisted living facility is for people who mostly take care of themselves, but need some occasional care in the process. Multiply that $43,000 by 3 years, and you get $130,000, guys. So there is a 70% chance that you're going to need at least this much money in your financial future as you age. So let's talk about Alzheimer's. This, unfortunately, was something my mom struggled with. It's a form of dementia, and it affects a lot of people. And they're doing a lot of great studies on this. It's a great, great charity to donate to. Hopefully, if you have someone in your family that is having to deal with, you pay close attention to this, because it's super, super important. They're making strides in this, and I know how difficult it was to take care of my mom in her final years, especially when she really didn't even know who I was. The greatest known risk factor for Alzheimer's is increasing age. A majority of people with Alzheimer's are 65 or older, but Alzheimer's is not a disease of old age. Approximately 200,000 Americans out there right now are under age 65 and have early onset Alzheimer's. Crazy. Planning for this general long-term care is like preparing for this disease, like preparing for a disease like Alzheimer's. You want to have all those questions answered, and you want to have that money in place to take care of you so that your family doesn't become burdened with the finances and the care if something like this unfortunately should happen to you. Well, many of the same planning steps apply. Certain steps take added importance. The loss, execution, function associated with dementia can create hardships for caregivers, and also for arranging or paying for the care of someone stricken with this terrible disease. While people with dementia may be able to live at home for some time, most will eventually need professional support, as those provided by skilled care facilities. There are many different types of long-term care services. Here are some of the most common. Adult daycare, where, it's a place that you can send your aging parent to be around other seniors, give them a chance to have some physical activity, some social activity, and get them out of the house, get some fresh air. And these people are trained to help them with their mobility and just basic quality of life. Really, really great thing. But you can see there's a cost involved, about $18,000. Assisted living facilities, quite a jump. These are people that are, can pretty much still take care of themselves, but they need a certain amount of assistance. And they typically will, you can have people come to your home, assist you with the common care needs, but you can see that the numbers jump considerably. This is the same for homemaker services when they come to your home, whether it's cleaning, whether it's bedding, whether it's helping move someone. The costs are pretty commensurate with those two in particular. Home health aides are often tasked in observing care of recipients' physical and mental health and reporting on the conditions to a registered nurse or other healthcare professional. They usually do not directly provide medical services. They're not trained for that particular thing. The average cost of the home health aide is similar to that of the homemaker. Very much in conjunction with that. And then finally, nursing homes. They offer 24-hour a day, 365-day a year care for people. Nursing homes have trained medical professionals. They provide specialized care to seniors. They take care of severe disabilities and illness like Alzheimer's and dementia, stroke issues, stuff like that. Specially trained staff, assistants, residents, help with all the activities and daily activities, and of course the housekeeping that goes along with that. This, unfortunately, is the most expensive option of long-term care. So around $7,500 a month is what you'd probably be looking at, or around $90,000 a year for a shared room. $100,000 on average for a private room in a nursing home. As a person ages and as their needs for support increases over time, he or she may use a variety of these services, starting with the least supportive and costly adult daycare and slowly progressing through the process and maybe potentially end up being in a nursing home. So you can see the need for financial wellness, the need for financial preparedness is pretty much laid out there for you. And in these later years, the cost can be pretty dramatic. So look at these two pyramids. I hope they will help you understand how much to include for long-term care and overall financial plan. One thing we know for sure, guys, 100% of us will get old. There's no two ways about it. The one factor that most people will be dealing with is their spendable income. Are you saving enough? Are you putting something away? We know that 70% of us, 7 out of 10, will need some kind of a plan with additional money. This would just be a base plan. This would just be the bare minimum that you probably want to have set aside for any kind of medical expenses or long-term care needs. 15% will need significant care. These are people with certain disabilities. Could be stroke, could be Alzheimer's, could be some of the things we talked about. A good plan would be, planning for around $280,000 to $300,000. And then about 2%, or 1 out of 50 out there, are going to need a significant amount of money. The likelihood is lower with these first two scenarios, but if your health and lifestyle criteria point to higher long-term care costs, it still may be wise to plan for the higher amount. Better to have it and not need it than to need it and not have it, guys. It's just that important. So before we jump to your long-term care options, we want to remind you how the government's long-term care plan is not sufficient to support your long-term care needs. Rough estimate is that Medicare can only provide about 20% of your long-term care needs, while the remaining 80% has to come from your financial sources. There's only a few situations that Medicare covers long-term care, which is the short nursing home stays under 100 days, with a high number of strings attached, of course, and limited amount of healthcare services that are offered. You'll get some services when your doctor prescribes them as a medically necessary to treat as part of a treatment for an illness or to prevent further deteriorating portion of your health. And lastly, hospice. Hospice care, if you're not seeking a cure for your terminal illness and you're not expected to live more than 6 months, Medicare will help step in and help with some of those costs. All of the other medical supports and needs are not covered, guys, including some of the very significant ones, such as the assistance with activities of daily living, bathing, dressing, all the things that get a little more difficult to do as you age. Post-hospital care, you fall and break a hip, whatever it could be, you know, you're going to need significant amount of care to get you back up and running and get you back home. Professionally trained staff or round-the-clock nursing help is not going to be taken care of. Personalized care plans designed for your specific needs. Senior rehabilitative help, such as physical, occupational, and speech therapy. Diabetes management and specialized diet plans. And then, of course, medication management, which is extremely important because as you get older, they have a lot of medicines that you need to take to control the different issues that you're having. We didn't want to mention Medicare without mentioning Medicaid. So, and this is just for your information, guys. It's certainly not a long-term care plan. Medicaid is really only there for people who are struggling financially and living on a very, very meager means. An individual or an annual income for 2 people would be around $16,000 or less to qualify for Medicaid. If you have a household with more people, that household would be $22,000 or less. This is less than the average Social Security payment and just above the government poverty level. Only a few nursing homes will accept payments from Medicaid. So let's not even consider this. We throw this out there so you know that it's available. But if you're part of this program, we're helping you develop the wealth and the strategies to put yourself in a better financial situation to where Medicaid is not something you're even going to be considering in the future. So, as a reminder, Medicare only covers long-term care for low-income individuals and benefits are very limited. Regular health insurance you have today follows the same coverage as Medicare, but is similarly very limited. When you retire, you're going to drop it anyway. You know, disability insurance is designed to replace your income, not to pay for services, so it does not cover long-term care. You need your own plan, and it can be a number of different sources. So it can be your savings. You know, you need to be planning, beef up your savings to at least around $200,000. It's very simple. Cash is king. You can do a lot of different things with that cash. You can also use equity from your house as a source of funding, but it has some constraints, and we're going to talk about that here in a minute. You could do an annuity to help pay for long-term care. Remember in the last lesson, I taught you that you can roll over money from aggressive investments as you're getting older and put them into something that will maximize and guarantee your retirement income. If you decide to take advantage of this, you may use it to cover your long-term care needs, which is a really, really good strategy. Fourth is a way to buy a special long-term care insurance premium. We'll talk a little bit about that. Last but not least, using permanent cash value from a permanent life insurance policy. And I'll touch on this a little bit as we move forward as well. So a lot of people try to pay off their house for retirement, despite the math showing that it's more profitable not to do so. Here's the old story of Brother A and Brother B. If you were part of our previous lessons, you remember the story. If you remember Brother B, who decided not to pay off his house, he maximized his tax advantages. He invested the extra money, and in 30 years, he had an additional $500,000 more than Brother A over here. That's why he's got that funny look on his face. If Brother B needs a long-term care plan, he'll have an extra $500,000 to pay for it. Or he can still use the home equity and he has plenty more options. Unfortunately, Brother A over here has less money, so using his home equity may be the only option for him. And let's assume that you have $500,000 in equity available in house. If it sits there, bringing zero interest, because equity in your home does not earn anything, so it's a pretty poor investment, and it's at 100% market risk. If the markets drop, it's not the bank losing money, it's the equity that you've accumulated in that house is going to disappear first. So can Brother A withdraw $50,000 a year for 10 years from his equity? Nope. He can't access the money to spend it. It's just not liquid. the only way he can get access to this home equity is to either sell his house or borrow it from the bank using his house as collateral. If you do not want to sell and you want to stay in your house, you can look at a reverse mortgage. It will allow you access to some of the home equity. Reverse mortgage is essentially a loan from the bank that is secured by your house as collateral. Because it is secured by your house, there is no credit history check needed to qualify, which is a good thing. You can get the cash in an entire lump sum. You can get a line of credit, or you receive monthly payments from the bank. Because it is a loan, though, any money you take out will incur interest, and that comes out of your home's equity for the amount that you've borrowed. Depending on your age, when you take out the loan amount and the loan interest rate, you could give up 30 to 40% of your home's equity. You will not need to make any monthly payments to the bank during this process. That's part of the arrangement. Instead, if the homeowner passes away, the bank sells the house to recoup their loan and the interest accrued and any other fees and expenses that were part of the contract. Any money left over will be distributed to your heirs, and that's pretty much how it works. Reverse mortgages can be a great financial decision for some people, but a poor decision for others. So this is something that if you're very limited on cash and other options, it might be worth looking into, but get all the information first. If you need additional help on this, reach out to us. We'll be more than happy to help you with it. People buying long-term care insurance to protect their savings. Okay, this is buying the actual long-term care insurance. Once you're unable to do 2 of the 6 daily activities, you can submit a claim to your long-term care insurance company. An insurance company will review all the medical records from your doctor and may even send a nurse out to confirm your medical condition before they approve the plan. After the plan has been approved, you will go through an elimination period for a few months, typically around 60 days, which is most common. During this time, you will have to pay out of pocket for your medical services. This is similar to having a deductible on any other type of insurance policy. Once the elimination period is over, though, the insurance company will start paying out for your medical expenses. But note that they will pay a daily limit of about $150 to $200. So if your care costs higher than that, you will have to come out of pocket for that. Also a note, there's a limit for lifetime limit, which is around $150,000 to $300,000. These amounts are usually enough for 2 to 5 years of decent care, depending on the level of your needs. The one single disadvantage of classical long-term care insurance is basically the cost. It's expensive, guys. Long-term care insurance may easily cost $2,000 to $3,000 a year, $2,000 for men, $3,000 for women, because women, of course, live longer. Insurance costs are not guaranteed to stay the same, and insurance costs may go up. Note that insurance companies cannot raise rates at will. They are heavily regulated by the government and cannot charge much more than what the services are actually costing. So, however, as our life expectancy grows, the long-term care needs becomes more expensive, and as a result, insurance companies have to raise their rates. In the recent, years, the past rates did jump a little bit. Actually, it almost doubled, because the insurance company has significantly underestimated the risk of long-term care costs and were allowed by the insurance industry to raise them. A lot of people faced a dilemma as to whether to just cancel their policies and lose all their money that they'd paid in, or just swallow it and take on the big cost increase. Don't want you guys to be in that situation. Another risk of classic long-term care policy is that it can be a use it or lose it situation. If you purchased a policy for $3,000 a year at age 50 and you're 35 years giving the insurance company your money, this is essentially giving the insurance company your money that you could have left to your family. Note, many long-term care insurances are beginning to change this use it or lose it approach because it's not popular with people, of course. And they're starting to return part or all of the unused premiums to the heirs. Just be aware of this before you're considering a long-term care policy. In the previous lesson, I demonstrated how deferred annuities work. Okay, this is some good stuff here. Around age 50 to 55, you need to seriously start thinking about securing at least a portion of your retirement income. You need to rebalance out of your aggressive investments and may decide to create a guaranteed income stream for your retirement using an annuity. You may purchase an annuity using a lump sum, or you may roll over some money from an old 401k or an IRA or some other qualified source. And money going from a qualified account like an IRA or 401k going into an annuity, which can also be a qualified account, the money can be moved tax-free and it will continue to grow tax-deferred. When you retire, in this example, at age 65, though, and the annuity will pay out monthly income throughout your entire life. The annuities are extremely flexible and configurable, which is nice. When you purchase an annuity, you can include long-term care rider along with the policy as part of the contract. And then such an annuity will become an annuity with long-term care benefit. So it's actually built into the annuity. Such an annuity has an extra pile of money reserved for your long-term care needs. If you end up needing long-term care, you submit a claim, you start getting the extra payments every month as a lump sum to cover those long-term care costs. Pretty nice. If you end up not needing it, it just turns into the reserve amount that you can be distributed to your heirs later on down the road. Permanent life insurance, though, for long-term care. Permanent life insurance, as I'm sure you'll hear in a minute, it builds cash value. That money you put in covers part of the insurance, but the additional money, if you fund it properly, and keep in mind, let me reiterate that, you fund it properly, it's structured properly, and it's funded properly, you can grow tremendous cash value in these things tax-free. You can use the money at any time for any particular purposes. You don't need pre-approvals to get your cash. You can spend it all or leave it to your family. And then you also have the tax-free transfer to your heirs when you finally do pass away. So let's take a quick look at this and just as a reminder to see how these things work. Every month, your money gets paid into the insurance policy and gets split into two parts. Part of it goes into the insurance. The other part goes towards your cash value growth. The second part is yours. It is safely invested, protected from market losses, and it grows tax-free within the insurance contract. Let me say that again. It grows tax-free within the insurance contract. This big green block right here on this chart shows your cash. Here you have $100,000 and you're in your 30s, okay? $750,000 in your 50s and $900,000 in retirement. Your cash value just grows over time, but your insurance needs diminish. So as you get older, your responsibilities and different things become less of a situation. Obligations slowly dissipate, and the need for significant protection for your family income diminishes as well. So the need for the protection goes down. In this example, you've got about $900,000 in cash value and $100,000 in insurance. But when you become older, wealthier, and have a fewer responsibilities and obligation, of course, you need less protection. So in your 50s, you need about $250,000. And then as you get older, just maybe a minimum of $100,000. Permanent life insurance will pay out no matter what. There is no term limits to this. This particular insurance policy is for $1 million. Sooner or later, you're going to get that $1 million. If it's later in life, it could be $900,000 from your accumulated cash value and $100,000 from the insurance company. If it's earlier, it could be $750 from your cash value, $250 from the insurance company, and you're even protected back in your 30s when your children and family are growing. When you need that protection the most, you have some cash that you can access if you need it, but you've also got the protection if, God forbid, something should happen to you. You can access your accumulated cash value. It's basically your money. It is your money. It is available to you anytime as you wish. No need to die to get it. Permanent life insurance is my preferred way to cover long-term care costs because one, I can spend 100% of all the money. If I don't need it for long-term care, I can use it for other things. I can use my money and insurance company's money for long-term care if needed as well. I can get access to the money tax-free. And anything that I was not able to spend will be passed on to my heirs tax-free as well. I hope they will throw a great party for me when that happens. All the personal financial experts in the industry strongly recommend having long-term care. Our old buddy Dave Ramsey down here, he talks about people, making sure they get it by the age of 60. Susie Orman, who's still a big believer in long-term care insurance, she recommends that you start shopping around age 50. Here at Wallio, we are similarly highly encourage people to have that protection in place. However, long-term care insurance is not our first choice. Like I demonstrated before, there's a significant chance rates might go up and you might not get all the benefits out of it. If you ended up never using it, all your premiums you paid, still may stay with the insurance company. You don't want that use it or lose it scenario. We recommend using the money to buy a permanent life insurance policy with the coverage of long-term care built in. You get more flexibility with it, and if you ended up not needing it, you may spend it as accumulated cash for retirement, or you can leave it to your family as a legacy to pass on to the next generation. The great thing is the sooner you get it, the bigger the cash value you can accumulate, better for retirement. All the options are there for you to take advantage of. Once again, let me reiterate though, the thing that makes this work extremely well, more so than any other options out there, is if you have a financial professional that structures it properly and then you fund it properly. If you do those two things, there's there's nothing out there that I know that can beat it. When you lose a loved one and you step up, to start planning for the funeral, there's dozens of decisions that have to be made. In fact, approximately 85 different things have to be decided upon when someone passes away. Some people have a clear idea of how they want their funeral and burial to be, while other individuals just don't care. Whether you have a perfect funeral plan or you simply don't care about what happens to your body after you die, it is still important to note that any type of funeral that is planned for you will not be cheap, and it will take time to plan and to execute. You certainly don't want to put that burden on your family. That's why we have these conversations. That's why we're talking about this as part of your overall financial wellness plan. We're planning, like we said, for today, tomorrow, and into the future. We're talking about the future now, guys. This is important stuff. So how do final expenses work? When help is needed, you make a call to the insurance advisor, and they're only one phone call away, 24/7, ready to personalize your funeral plan. You can compare and negotiate prices. You can work out all of the different aspects of your final needs, and all these benefits are tax-free. Not only will it save you money in the long run, but it'll also avoid all the hassles of going through different funeral homes where salespeople will try to upsell your family in an emotional time where it's going to be tough for them to make the decisions. And it can be a very, very stressful situation to put them in. Besides final expense insurance, such as Everest, for example, this works worldwide. What's nice about this is if you get a final expense plan through a reputable insurance company, doesn't matter where you are in the world, if something happens, they will take care of you. They will make sure you get taken care of properly, and all of your wishes that have been already planned out will be executed to the letter. Most of us want to make a positive impact in the world. I really, truly believe that. I think we're all put on this planet for a reason, and I think we need to be in service to each other to have a really fulfilled life. But planning ahead can mean leaving a positive legacy for a family member to remember you by. Warren Buffett said one time, someone is sitting in the shade of a tree. Someone is sitting in the shade today because someone else planted a tree a long, long time ago. That means somebody thought about the future. They thought about the future needs of their family member and what could they do to make life a little bit better for them. That's the things we've been talking about this evening, guys. Very, very important. How do you want to be remembered? Carve your name on their hearts, not the tombstone. A legacy is etched into the minds of others and the stories that they share about you. So don't leave things to chance. Plan ahead, starting now, so that the legacy that you leave behind is not one of hardship and burden, but of peace and positivity and financial wellness for your loved ones. Those are the kind of stories you want people to share about you. Medicare didn't pay for everything, guys. We'll find the rest of the money somewhere. This is for people who did not plan for their future. I don't think you want to see this guy anytime, anywhere, in any situation. So let's stick to the game plan and make sure that you don't ever have to have this guy as part of one of your medical examinations. Last but not least, you don't want a bunch of clowns taking you to your final resting spot. I guess maybe if you have spent time in the circus, it could end up like this, but I don't think this is how most people envision being laid to rest. Low budget funerals, of course, you get what you pay for. And I certainly don't want a bunch of clowns carrying me to my final resting spot. I want my family to celebrate, have the money to enjoy time with each other, and telling good old stories about me long into the future. It's been my pleasure to be with you guys this evening. Looking forward to sharing week 12 with you. It's going to be exciting. It's going to tie all these lesson plans together, and I know you're going to get a lot out of it. So looking forward to seeing you next week. Take care, be safe, and take care of your finances. Get your homework done.